Imagine getting paid just to own a piece of the biggest companies in the world. Sounds too good to be true. Well, there's a catch. Hey everyone, welcome back. Today we're diving into something that's got everyone talking. SCHD, the Schwab US Dividend Equity ETF. It's praised as a reliable source of passive income, but is it really as good as it sounds? Many people believe that owning SCHD means easy money and a stress-free retirement. But before you start dreaming of living off dividends, there are some important facts you need to know. This video will break down the real story behind SCHD, its pros and cons, and whether it's truly a sustainable way to live off your investments. I'll be covering some surprising truths and debunking some common misconceptions about this popular ETF. So if you're thinking about adding SCHD to your portfolio or are just curious about how it works, stick around. You might be surprised by what you learn. Let's get started. Chapter 1. What is SCHD? SCHD stands for the Schwab US Dividend Equity ETF. It's designed to help investors earn steady income through dividends, making it a popular choice for those looking to build a passive income stream. SCHD is made up of a diversified portfolio of large, established companies that have a strong track record of paying and growing the dividends. Some of the top holdings include big names like PepsiCo, Home Depot, and Cisco. What makes SCHD attractive is its focus on high-quality companies with stable financials and good cash flow. This approach has helped it deliver a solid dividend yield of around 3.7%, which is much higher than the average yield of the S&P 500. But SCHD is not just about dividends. It has also performed well in terms of total returns, although it may not always beat the broader market. Since its inception in 2011, SCHD has become one of the most popular dividend ETFs, with over $50 billion in assets under management. It's often compared to other dividend-focused funds, like the Vanguard Dividend Appreciation ETF, or VIG. But SCHD stands out for its combination of yield and dividend growth. Chapter 2. Misconception about dividends. Many investors think dividends are just free money that companies hand out, but that's not entirely true. When a company pays dividends, it's actually sharing a part of its profits with shareholders. This means the company's value decreases by the same amount it pays out. So while you get cash in your pocket, the stock price usually drops by a similar amount. Another big misconception is that dividends don't have any tax implications. In reality, dividends are subject to taxes. First, the company pays taxes on its profits. Then, when those profits are distributed as dividends, shareholders have to pay taxes again. This double taxation can eat into your returns, especially if you're not holding SCHD in a tax-advantaged account like an IRA. Lastly, some people believe that high dividend yields are always a good thing, but a high yield can sometimes be a warning sign that a company is struggling to sustain its payouts. It's important to check whether a company's earnings and cash flow can support its dividend payments over the long term. SCHD does a good job of screening for companies with solid fundamentals, but it's still something to keep in mind. Chapter 3. SCHD versus other investments. Let's see how SCHD stacks up against other popular investments. One common comparison is with the S&P 500, which represents the broader US stock market. While the S&P 500 focuses on capital appreciation, SCHD prioritizes income through dividends. This means SCHD generally provides a higher yield, around 3.7% compared to the S&P 500's modest 1.2%. But does this higher yield make SCHD a better choice? Not necessarily. In terms of total returns, SCHD has had a solid performance, but hasn't consistently outpaced the S&P 500. For example, since its inception in 2011, SCHD has delivered a total return of around 306%, while the S&P 500 has returned approximately 350%. This difference is largely due to the tech stocks that dominate the S&P, which have seen explosive growth in recent years. Comparing SCHD to other dividend-focused ETFs like Vanguard's Dividend Appreciation ETF or VIG reveals more nuances. VIG focuses more on companies that steadily increase their dividends, while SCHD includes a mix of high yield and dividend growth stocks. This gives SCHD an edge in terms of immediate income, but it may lag in total return during bullish market phases. What about bonds or real estate? Bonds are generally safer, but offer lower yields, especially with current interest rates. Real estate investments like REITs can offer high yields, but come with their own risks, such as market volatility and property management headaches. SCHD offers a balanced approach. It's less volatile than individual stocks, but doesn't sacrifice yield like some lower risk options. It's a good middle ground for those looking to generate income without too much exposure to the ups and downs of the market. But like all investments, it's important to weigh the pros and cons against your financial goals and risk tolerance. Chapter 4: The Myth of Living Off Dividends Alone. Many people dream of living off their investments, but relying solely on SCHD's dividends can be more challenging than it seems. Let's break down why. Suppose you have $1 million invested in SCHD. With an average yield of around 3.7%, that gives you about $37,000 per year before taxes. It sounds good, but is it enough? First, consider taxes. If you're not using a tax-advantaged account, you'll pay taxes on those dividends. Depending on your tax bracket, this could reduce your income significantly. Plus, inflation eats away at the purchasing power of your dividends over time. A $37,000 income today may not cover the same expenses 10 years down the line. Next, think about lifestyle. $37,000 might not be enough to cover all living expenses, especially if you have a mortgage, healthcare costs, or want to maintain a certain standard of living. In that case, you'd have to dip into your principal, selling shares to make up the difference. This can reduce your investment's ability to grow and provide income in the future. Moreover, relying solely on dividends can lead to a risky situation in bear markets. If the market drops and you're forced to sell shares for income, you could end up selling at a loss, hurting your long-term financial stability. A more balanced approach would be to use SCHD as one part of your overall strategy. Combine it with other sources of income, like a part-time job, rental income, or other investments. This can help you maintain a more sustainable financial situation, even if market conditions change. Living off dividends sounds appealing, but it requires careful planning and realistic expectations to make it work long-term. Chapter 5: The Case for SCHD Despite Criticisms. SCHD isn't without its critics. Some argue that it's not diversified enough or that it's underperformed in recent years compared to other ETFs. Let's address these points one by one. First, the concern about diversification. SCHD holds around 100 stocks, which is fewer than some other dividend ETFs like Vanguard's VIG or the S&P 500. Critics say this makes it riskier, but the companies in SCHD are carefully chosen for their strong financial health and consistent dividend growth. These are mostly large, stable companies that can weather economic downturns. Another criticism is SCHD's recent underperformance. In 2023, SCHD didn't do as well as some of its peers, particularly those with heavy exposure to high-growth stocks like technology. This is because SCHD focuses on traditional dividend-paying sectors like consumer goods and industrials, which tend to be more stable but less explosive in terms of growth. While this can be a downside in bull markets, it can also provide a buffer in downturns, making SCHD a reliable choice for income-focused investors. Some also argue that SCHD's yield, while attractive, isn't high enough compared to other high-yield investments like REITs or certain bonds. But these alternatives come with their own risks. High-yield investments often have more volatility or lower dividend growth rates, which can impact long-term returns. SCHD strikes a balance by offering a solid yield with steady growth, which makes it a strong option for those looking to generate income without taking on excessive risk. Despite its drawbacks, SCHD remains one of the best choices for dividend investors. Its focus on quality and consistency means it's more than just a short-term income play. It's a long-term strategy that, when used wisely, can provide stable returns and peace of mind through market ups and downs. Chapter 6. Conclusion. To wrap things up, SCHD is a solid option for anyone looking to earn steady income through dividends. It combines high-quality companies with a strong track record of dividend growth, making it an attractive choice for income-focused investors. However, it's crucial to remember that living off dividends alone isn't as simple as it seems. Taxes, inflation, and market volatility can all impact your returns. SCHD should be viewed as part of a broader investment strategy rather than a standalone solution. For those interested in adding SCHD to their portfolio, consider pairing it with other investments like bonds, real estate, or even a low-cost index fund to balance risk and growth. And always keep your financial goals and risk tolerance in mind. While SCHD offers reliable income, it's not a magic solution for financial freedom. Do your research, diversify, and invest wisely to achieve a stable and fulfilling financial future.